Eaton here. In this reading, we're going to cover the basic characteristics of equity securities and learn some terminology about equity securities. So let's jump right into that. Now, equity securities pay dividends, but these aren't an obligation of the firm. They can be variable. The common stock dividends, the regular quarterly dividends, are decided on by the board of directors. They meet quarterly and decide how much the dividend is going to be, when it's going to be paid, and all that. And we say it's not an obligation, either the dividends on common stock or dividends on preferred stock, because if the company misses those, they're not in default as they would be by missing payments on a debt security. We say that common shareholders have a residual claim to the firm's assets, and this just means that their claim stands behind the claims of bondholders and the claims of preferred stockholders, both in terms of their claims to earnings and their claims to the value of the firm assets in case of a liquidation. Common shareholders vote for the board members that determine the policy and appoint the top management of the corporation. But sometimes there'll be different classes of common shares. Even though they may have the same economic claim to the firm, they might have different voting rights. Sometimes founding families over time issue themselves stock that has super voting rights, so that even though economically they may only own 20-25% of the corporation, by owning these super voting shares, they can still control the corporation effectively. Now, there's a couple kinds of voting for the board of directors. There's statutory voting and there's cumulative voting. There's an important difference in the outcome. Let me try and explain that to you. Assume there's 3 board positions that are up for vote, and a shareholder owns 100 shares. Well, under statutory voting, there'd be 3 elections, and that shareholder would have 100 shares to vote in each election. Now, with cumulative voting, if there's 3 positions, there'll only be a single election, and the top 3 vote getters will get the positions on the board. So with cumulative voting, our shareholder with 100 shares will get 300 votes, and they can vote that for one candidate or spread them across candidates. Well, the real implication of this is for minority shareholders. Think of a corporation where there's one shareholder that owns 51% of the shares. If there are individual board of directors seat elections, as with statutory voting, then that 51% owner could win every one of those elections and choose all the board members. With cumulative voting, however, if you had 35% of the shares, you'd have enough votes to elect one of those 3 seats. So in the case of cumulative voting, minority shareholders can get representation on the board of directors that they might not get with statutory voting. So that's the important difference there. Now, preferred stock, which I mentioned, has priority or a preference over common stock. The dividends aren't an obligation, as I mentioned, but then there's no maturity date. So it's a little bit similar to debt. The payment is fixed in that the dividend is stated at the time the preferred stock is sold. And except for missing that dividend because of lack of funds to pay it, that dividend is always the same. And so it's a perpetual interest-bearing instrument viewed that way. Now, preferred stock typically doesn't have any voting rights and doesn't participate when the firm does well. So you typically get a higher dividend on the preferred, a significantly higher dividend rate, and more, I guess, certainty, less uncertainty about the value. But on the other side, you don't have the upside. The firm does really well. Well, the best you're going to do with the preferred is to get your dividends paid on time. And in terms of preference, most preferred stock is what we call cumulative, meaning that any dividends missed accumulate and must be all made up before the firm can again begin paying common dividends on the common stock. So that's a cumulative preferred. Now, a participating preferred does have some upside because it receives extra payment if the firm does well. and the claim can exceed the par value or the stated value if the firm is liquidated. So most preferred is cumulative. Some small subset of preferred may be participating preferred. Convertible preferred stock gives you even more of an upside because those shares can be converted into common stock. So if the firm does really well and the common stock goes way up, you can convert the preferred stock into the now much higher valued common stock and benefit from the success of the company. And this is less risky than common stock, but more risky in most instances than regular preferred stock. That is, if you want more of the upside, you get more of the risk. Now, some common shares and some preferred shares may be callable or puttable. Now, this is not a terribly great amount of these shares, but they're terms that you should know. And callable means that the firm has a right to call them back in. There is a price at which the firm can say, we're paying you these price, give these shares back. So that's callable shares, and we say they have a call feature. Shares that are puttable, that's an option that the shareholder has to put the shares, give them back to the company for this pre-specified amount. And so puttable shares are going to have less risk than regular shares as long as the company is in still good enough shape to follow through on your put option, has the money to give you when you put your shares back to the company. Now, we talk mostly about public equity. We think about stocks that trade on the New York Stock Exchange or the NASDAQ or the London Stock Exchange. But there's also private equity, and this is just not registered for public trading. There are many, many corporations that exist and have shares outstanding that are not publicly traded. Well, the advantage of private equity is the reporting requirements are less. In order to register shares to trade publicly, you have to register with the SEC in the U.S. or the Financial Services Authority in the U.K. And make a lot of disclosures and jump through a lot of hoops. Now, with private equity, you may be able to focus more on the long term because you don't have shareholders and prices quoted every day that put extra emphasis on short-term performance and short-term results. And there's potentially a greater return for investors if or once the firm goes public, because with the greater liquidity, typically the value is higher. Some of the disadvantages is that it is less liquid, and it makes it more difficult for the firm to raise capital if they can't issue publicly traded securities. There's less disclosure with private equity, as we mentioned, and this may weaken corporate governance, that they don't have to disclose all that information and jump through all those hoops that we associate with publicly traded equity shares. Some of the types of private equity, well, venture capital is private equity. Venture capital firms provide financing for the early stages of firm development. Leveraged buyout, in this case, it's often a publicly traded company that's taken private. They use a lot of leverage, that is, they issue a lot of debt to buy the company and buy all their outstanding stock. Now, if management is leading this leveraged buyout, then we refer to it as a management buyout. And a PIPE, or private investment in public equity, sometimes public firms can raise equity capital in a private placement. They issue some new shares, but they do not register them for public trading. And so they're sold on the private market, and there's restrictions on who it can be sold to. Now, if we talk about investing in foreign equities, there's some advantages and there's some disadvantages. Clearly, some of the advantages are getting the exposure you want and having the ability to invest in a wider range of companies around the world. But it may be the case that your investment and your return are denominated in a foreign currency, so that can be a disadvantage. It adds another layer of risk to the transaction. Often foreign markets are less liquid and offer less transparency. I know we've run into some trouble with that lately with some Chinese stocks that have been trading, where the transparency just isn't yet what we've come to expect and what investors really need to make informed decisions. Exchange regulations and procedures may be quite different across countries, so you have to be familiar with all the differences that are out there. And so this is the idea that, well, direct investing has some costs and some challenges. Depository receipts offer another way to invest in foreign shares. In this case, the foreign shares are deposited with a bank in your domestic country. And then claims to these deposited shares, these are the depository receipts, trade like a local stock in local currency, although they represent ownership of foreign securities. And the accounting standards and the market procedures for the bank depository shares are now the same as the local market. So this has been a popular way over the years, especially early on when markets were less integrated, to purchase shares in a company that's domiciled in another country. So let's get some of the terminology down here. Depository receipts can be sponsored or unsponsored. Well, if they're sponsored, then the issuing firm, the firm whose stock we're talking about, is involved with the issue. Investors will have the same voting and dividend rights as foreign shareholders. And there's greater firm reporting requirements with sponsored depository receipts. In the U.S., for example, they must be registered with the SEC. Now, in the case of unsponsored depository receipts, the bank, the depository, buys the shares in the foreign market. And in this case, the bank owns them and retains the voting rights and hopefully votes in the interests of the shareholders. But these unsponsored ones, you have a little less rights than if it's a sponsored depository receipt where the issuing company is involved with the creation of the depository receipts. Now, within this world of depository receipts, we have some more terminology. Besides sponsored and unsponsored, we have global, American, global registered shares, and baskets of listed depository receipts. Well, global depository receipts just refers to depository receipts that are issued outside the U.S. and outside the firm's home country. Most of these are denominated in U.S. dollars. Lately, some have been denominated in pounds and euros. Now, American depository receipts, that's the oldest and most common type. These trade in U.S. markets, either over-the-counter or on U.S. exchanges. They're denominated in U.S. dollars. We refer to these as ADRs. Okay? So, foreign companies issue depository receipts in the U.S., American depository receipts. Outside the U.S., they're called global depository receipts. Now, global registered shares are identical to the common shares that trade in the local currencies on the local stock exchanges, and then these trade worldwide, these globally registered shares. It's just a way of having these shares more liquid and available to people as they're trading on various exchanges around the world. When we talk about baskets of listed depository receipts, this is a portfolio of depository receipts. So, like an ETF, right, that has a portfolio, but these are portfolios of depository receipts, and listed means that they trade in the public markets. Well, let's get to some of the return characteristics of equity. Equity pays dividends. Much of it does, some doesn't. We usually think that younger growing companies that can earn a lot on reinvesting their earnings pay less dividends, and more mature companies pay out more of their earnings as dividends because their opportunities for reinvestment and growth in their companies are not as great. Now, that's not always a clear dividing line, but typically that holds true. So from your equity, you can get dividends, and the other way you make money on equity securities is if the price goes up or appreciates. That is, you get a capital gain. But of course, you're exposed to capital losses as well. Over recent years, share repurchases have gotten more popular, where instead of returning earnings to shareholders by way of regular dividends, they return it by repurchasing shares. If you've invested in foreign equities, you also have return, or, well, I guess return, either positive or negative, on the foreign exchange change, that is the change in the exchange rates between the countries. And interestingly, compounding of reinvested dividends has historically been 2/3 plus of investors' compound returns on equity securities. So if you bought some equity securities, they reinvested the dividends in those shares and let it grow over 20 and 30-year periods, over 2/3 of those returns have been from the dividends and the earnings on reinvested dividends. Now, whether that holds true over the next 20 or 30 years, we don't know, but it's certainly been an important part historically of the returns on equity securities. What about their risk characteristics? Well, we know that preferred stock is less risky than common stock because of its fixed dividends and this preference to receive distributions before common stock can be paid any dividends. And you also have a claim to the par value or stated face value if the firm is liquidated. After the claims of debt holders, but remember, before, preference over the claims of common shareholders. So in terms of risk, debt, preferred stock more risky than debt, common stock more risky than preferred stock. Now, in issuing equity, companies seek funds to buy assets to increase shareholder wealth, or at least that's what they're supposed to be doing. So a firm raises money, right? They've got to finance the assets that they have in order to run their business, the assets that really are their business, plus their employees, of course. So the funds could be used to buy other companies or for employee incentive compensation, and by that we just mean employee stock options. Okay. And it decreases the firm's reliance on debt financing. Debt really has to be paid, right? The interest has to be paid, and the equity just kind of along for the ride. But a company's capital structure, that is how it raises the money to finance its assets, can have different ratios of debt financing versus equity financing. Excuse me. We've got a learning outcome statement here that says you should know the difference between book value and the market value of a share of stock, and I think you probably already do, right? Book value of equity is the balance sheet value. We take shareholders' equity or common shareholders' equity and divide it by the number of shares outstanding, and that's the book value of the equity. The market value, on the other hand, is the price at which it's trading in the marketplace, and this reflects expectations regarding not only risk, but about futures cash flows, growth of earnings, growth of dividend distributions, and things like that. So just make sure you don't get these two confused. One is an accounting value, and the other one is determined in the marketplace by supply and demand for the shares. Now, this last slide here, we need to distinguish between the return on equity and the cost of equity. Now, I said the firm raises some money by issuing debt and some money by issuing equity. So when we go to calculate the return on equity, we want to go down the income statement until we've taken out both interest and taxes in order to get the return on the equity that's invested in the firm. But these are accounting measures here. The numerators, net incomes, or net income available to common, and the denominator, average equity, from the balance sheet. Now we'll compare that to the cost of equity. Well, when we talk about the cost of equity, we're talking about the required rate of return. And this is some combination of the dividend and growth, expected capital gains. Now, it's difficult to estimate compared to the required return on debt, because with debt, we just go into the marketplace, we see the yield to maturity on the firm's debt in the current market. That's the required rate of return, or at least the pre-tax required rate of return on funds that are raised by issuing debt. But we can estimate the cost of equity, and I guess the last important point here is the job of financial managers to keep ROE higher than the cost of equity. The idea is that a firm should earn more on its invested assets than it costs to finance those assets. And that's how firms grow. If their cost of equity is lower than the returns they can generate on that equity that they raise, then over time the firm will get more valuable and investors will earn what we all want to earn, and that is something higher than the equilibrium or required rate of return on the common stock.